All right. Hey, what's going on in banking, of course? And welcome everybody to What's Going On in Banking 2025. I'm Ron Shevlin, Chief Research Officer at Cornerstone Advisors. And as always, I have the privilege of doing this every year with my boss, CEO and founding partner at Cornerstone, Steve Williams. Steve, thanks a lot for joining me again on this.
Thank you, Ron. I love geeking out on banking and all things financial.
Absolutely. And I want to thank the marketing team and Bailey Wishart in particular for that opening sequence. I'm sure you all remember the previous year's covers of what's going on in banking 2024 and 2023. Each year we try to come up with a cover that kind of reflects the mood of the industry. And back in 2023, it was not a good mood at all. Definitely, there were some concerns about regulatory issues, the economy. Things were not real positive, and that's why we came up with sort of the boat on a storm. Last year, I thought the mood was a little bit different going into 2024. Not as dire as it was the prior year, but saw a lot of financial institutions really trying to figure out, well, what's the next wave? What's coming down the pike? A lot of technology types things. So that cover was trying to display finding the next wave. This year, a little bit calmer storms. Wouldn't exactly call it happy days are here again. My editor was not particularly happy that I wanted to just stick the letters ER at the end of the word happy instead of spelling it correctly. But that was the mood, I thought, of the industry, that while it might not be happy days are here again, at least it feels a little bit better. Steve, your comments on that?
Oh yeah, I think you could sense the mood start to change. We'll talk a little bit later about bank stocks and how they've reacted. I think it's really two things. I think there's a feeling of maybe moving into more of a growth agenda on a national basis. And I think especially, I had a banker say a few weeks ago, we faced the worst regulatory environment of his career over the last 4 years. And this was not a young banker. So I think both the regulatory side and the growth side are the two areas where I saw optimism really shift late in the year.
Yeah, and we'll talk, get into even more detail around that, Steve. I want to just kind of tee up the discussion a little bit and let everybody know some of the topics we're going to discuss. And so, there's our cover slide for this year. So we got a whole bunch of things, Steve, to cover. I'm not going to spend a lot of time going through this because no one's going to remember it once we get into it anyway. But we'll talk about technology, regulations, the equity market, threats, and so forth. And if we have time later. And I do want to encourage everybody to throw their questions into chat. There is a Q&A button, but I don't know that we'll be monitoring that as closely as we will the chat window. So please put any questions or comments you have in the chat window. We'll be monitoring that as we go along. And I also want to let everybody know that, Steve, you've seen this a couple of years now. I like to reference a lot of songs in my both my speeches that I do, as well as the reports that I write. And there are 21 song references in this year's What's Going On in Banking.
So I love it. I love it.
Yeah, you love it because you're like close to my age. No one's going to get most of the references here because they're all 70s and 80s music. But hopefully people will find them. So we've created a bit of a contest here. If you can find all 21 songs, and you need to reference them by name, not just the citation in the report, but the actual song names. We've got a link on the site. Mary actually posted the link in the chat window. Send us the songs. There are 21 of them all together, and you get them correctly, and you'll be could be one of 5 winners with a $100 gift card. I will say this. If you think you're just going to throw the report up into Chat GPT and have it do the work for you, you're going to be very disappointed. I tried it myself. It didn't come up with 21 songs, and the ones it did come up with weren't all the correct ones. So,
Luke, use the force. Don't use automation.
You actually have to do the hard work and read the report. So, Steve, as you know, for the last 10 years, we've been looking at optimism and pessimism about the industry. And we've been pretty consistent, at least over the last 5 or 6 years, with the question, how optimistic or pessimistic are you about the prospects for the industry, not your institution? Kind of learned the hard way that a lot of folks always very optimistic about their own institutions' prospects. But I got to tell you, looking over the last 5, 6 years, I have never seen the optimism numbers this high. 7 out of 10, at least somewhat optimistic, another 12%, very optimistic, which is why we characterize this as happier days, especially compared. Is this jiving with what you're seeing and hearing from folks in the industry?
Yeah, and it may be because we came from that stormy pessimism. If you recall, 2023, obviously was a really rough year. So coming out of 23 into 24, it was a lot of fear still in the marketplace. And we'll talk about deposits and liquidity. The one thing I'd say is I'm a banker, so when I see optimism, it scares the crap out of me. And what I would say is, while people are feeling good about prospects for growth, and especially maybe a different regulatory environment for what I would call the innocents, Ron, the good banks and credit unions who are just doing their job and felt like they were beat up for no reason, I think they're feeling more optimistic there. That said, I want to point out one thing. I see a lot of strategic plans, a lot of operating budgets coming through the board meetings in November, December. And I don't think any CEO is out there going, I have nailed my budget and my earnings targets for 25. There is a lot of work to do, despite kind of maybe some macro optimism.
Yeah, a couple reactions, Steve. First of all, agree with you about the general conservatism from an outlook perspective of bankers. When I see 71% say that they're somewhat optimistic, I think that's pure jubilation. The other thing I want to point out too is we fielded the survey in December of 2024, so post-election, but pre Trump taking office. And what we've seen I can't help but wonder if I had refielded this today, if we would see these same numbers. Because I think there's a lot of skepticism and concern about while the regulatory environment is changing, too much change too fast, I think may characterize a lot of folks' perspective here.
Mhm. Yep.
Awesome. Okay. Every year, Steve, we also look at the execs' top concerns for the year. And you see very similar lists between banks and credit union execs, maybe a little bit different. Deposit gathering at the top of the list for banks, but right there in the top 5 for credit unions. New member growth at the top of the list for the credit unions. Efficiency, non-interest expense there. I do want to point out that both cybersecurity and consumer-related fraud have historically not been in the top 5. So I think this is a really important kind of trend. Your thoughts on this?
I think that we really have to take note of how, if these are songs on Casey Kasem's list over the last 5 years, Ron, cybersecurity and fraud just keep heading up number one with a bullet. So, and I've seen this at board of directors are really concerned about these two things. And I think we kind of give them maybe a little bit of a patronizing, we're going to be fine. I think that when I see military veterans on board of directors, they especially are concerned about this. So I just think we have to take this really serious. To quote one military board member on a bank I work with, this is war. So yeah, absolutely. And it poses that point that we just, from an operational risk, we got a lot of work to do, and that does require investment. And sometimes it gets scary when we get to budget time, but in both fraud and cyber, information security and financial crimes, a lot of investing to do.
Yeah. So we got a question from Derek, and I don't know Derek's last name, but he asked, why is growth not a top 5 priority for the banks? On the bank side, we do ask, we ask them and prompt them for new customer growth, and that did not make the top 5. What's your take, Steve? Why growth isn't a top 5 priority for the banks?
And to the point, we work, Derek, in the regional community bank space, and a lot of them are kind of liquidity constrained for growth. So if they don't get number one deposit gathering, they really couldn't put customer growth on the list. And I think that that's really important, Ron, when we think about, why deposit gathering is still here, almost 2 years now after SVB, et cetera. Well, if you look at the macro trends, one that just strikes me, when COVID started, there were $3 trillion of funds in money market mutual funds. Today, that number is 6.9 trillion. So that's a lot of funds that are not in banking that we're fighting for on a yield and rate basis. And then you're our research officer. You write a lot about the fintechs now starting to gain more liquidity. And then in a higher rate environment, the challenger banks. So between mutual funds, fintechs, and challenger banks, it's just, we're not returning to, oh, let's just turn the lights on again. Deposits are going to flow in. This is a systemic competitive issue.
Yeah, a couple of reactions to that, Steve. First of all, thanks for the question, Derek. Appreciate you weighing in on that. I do think that on the bank side, Steve, I don't know the numbers, but you do find that a lot of commercial community banks aren't necessarily very consumer oriented. So I think that brings down the weighting of new customer growth on the bank side. But it does go to show that the deposit gathering, and there's something that kind of have seen now. I think I've been using the term deposit displacement for about 10 years now, back when the fintechs and the neobanks were first coming in. But it does seem like it's really beginning to hit harder. When we asked the survey respondents about the threats to the banking industry, and we've been asking this now for the past couple years, a couple of trends we see, and this aggregates both the bank and credit union executive responses. Between 2023 and 24, there was a big jump in terms of the percentage who saw the big tech companies, the mega banks, and the big fintechs and the challenger banks all as significant threats. Going into this year, a little bit less on the big tech side. I think the threat of Amazon has abated a little bit, maybe even Apple as well. And I'm not sure if that's the case, that's a good assumption. Mega banks still up there, but look at the fintechs, both the big fintechs and the challenger banks continuing to rise. I do think that that's where the deposit displacement is, especially with the big fintechs like the Chime, and people will argue whether or not they're really having that kind of a impact. But PayPal and Square in particular, you look at their growth, you look at the growth in payments, and even like Robinhood. I heard that Robinhood earned like $800 million last year in interest income. They are basically getting their customers to open checking accounts in order to fund their investment activity. And I think a lot of the community banks and credit unions, Steve, are feeling that pain.
Yeah, I think so. I think there's really two types of fintechs or challengers, Ron. There's those that like, hey, rates are high again, so we're going to have a great money market or interest-bearing checking yield. But that's not what Chime does, and that's not what Venmo does. And they're really kind of getting that more lower, younger, less liquidity household for transactions. And I always bring up that book, The Innovator's Dilemma by Clay Christensen, that the warning sign is not that those younger consumers are taking big balances away today, but they're taking brand equity, attention, usage away from the typical commercial or retail bank right now. So keeping an eye on the household growth is an early indicator. When they get older, what's going to happen to liquidity and balances. And that's why I think this is a long-term competitive thing, not a seasonal thing with what the Fed does when it comes to deposits.
Yeah, James asks, any new or good strategies for gathering low-cost deposits in a bundled product strategy? And I do want to point out to James that we did ask and reported in the survey, we asked about what deposit strategies were working, what the respondents are deploying, and what worked in 2024. And I think the reality, Steve, is that the number one most effective strategy or tactic was raising rates. I know no one wants to do that, but it does seem to be what works. Any other things that you think? And then also a lot of analytic approaches. But my concern, Steve, there is that, if you don't have a good analytics engine now, yes, it's still worth building out for the next wave, but it is, it's going to take some time. So any things that you would point to?
Yeah, I picture a brainstorming room where somebody goes, "What if we raise rates?" What a lame brainstorming. But no, it's hard to the point about what's out there. I think where there's a little bit of room is, to your point, Ron, using analytics to say I need to grow, but at what cost of funds? So maybe if I'm sharper on the analytics, I might grow 200 million in deposits, but instead of raising my rates 15 basis points, I only raised it 9. And if I'm a $10 billion institution, that's a lot of money. That's $6 million I just saved. The other thing I'd say is there is no magic bullet, but if you have a really clear segmentation strategy. So this is my small business segmentation plan. This is my C&I plan. This is my specialty finance plan. and this is my mass affluent consumer plan. If I can't walk into your bank and inspect your segmentation strategy, then you haven't done enough work yet on deposit growth.
So, Steve, I couldn't agree with you more on that. I actually spoke with a reporter from Financial Brand yesterday who's doing a report on what type of mobile banking features banks and credit unions should be prioritizing. And my answer to him was that I can't even answer that question. I couldn't care less about mobile banking features and functions. What I care about is the product offering. And so I agree with you about the segmentation, but I think that the manifestation of that segmentation, Steve, is a differentiated product offering. It isn't simply
Mhm.
about targeting your marketing and communication efforts to a segment. It's about tailoring the product itself. And I think let's see, who was it? I think it was Rich here who says those deposits in the hood are not coming back to the bank and credit union. I disagree. I think there's a huge opportunity for banks and credit unions. Maybe I'm just an optimist here, but I do think there are opportunities. But it isn't from just marketing and going, "Hey, we have the best branch personnel." It's about recreating and creating and reinventing the product offerings. So I think
Yeah.
we're actually going to see a lot of more chief product officers. And Steve, I know I'm going to piss a lot of people off with this, but I think the era and age of the member or customer experience is now dead. It's about time to focus on the products. I think we're going to see a shift from the chief experience officer to the chief product officer.
Well, you always say radical things that tick me off, Ron. So, I mean, obviously, what you're not saying is at the expense of a crappy experience. You're saying experience is somewhat table stakes, but if you don't manage product innovation and product segmentation and just say, I have a great experience, best cup of coffee in the world, you're not going to get that market share growth. And I'd agree. I had a $12 billion client, total assets, recently create a chief product officer role, chief strategy and product officer, and centralize the product manager. So that may be something we see a bit more like a fintech or a tech company runs product than a traditional bank.
Yeah. So I do want to go back to our list of issues, Steve, and mention when I put up the list of the concerns that fraud it has cracked the top five for the first time in a long time, and this really does seem to be an epidemic proportions. And what I find really distressing is when average consumers are actually contributing to the fraud. I mean, here's an Onion article. A genius outsmarts bank by using credit card to pay off other credit cards, which I'm sure most folks will remember was a
Brilliant.
bit of a meme about a month or two ago on LinkedIn in particular, when some guy decided that this was a good strategy.
Yeah, what's interesting though is we see this. You see a lot of this with Cash App fraud. And I hate to say this, but you've got a beautiful 100,000 customers or million customers. I got to tell you, 3 or 4% of those folks, given the opportunity, will take advantage of something. We saw that with Chase, paying immediate credit on checks through the ATM, and it was like roaches came out from under the fridge. So, yeah, I think it's a big thing, and it's important to know, how fast a fraud opportunity can even spread on social media among folks saying, "Hey," and it's because people don't like big institutions. They think there's a bit of situational justice in it as well.
Yeah. So, being a little more serious for a moment, what can mid-sized financial institutions do to address some of the fraud? Are there things that they
Yeah.
aren't doing that it should be? I mean, obviously, I think there's a lot of faith being put into machine learning and new AI types of technologies and approaches, but these aren't new technologies. They've been around a long time, so I'm not sure. Maybe there's some effort in terms of addressing
Yeah.
some payments things on a real time basis, but are you seeing anything, or do you think there are things that the financial institutions should be doing that they're not?
I think the best uh, institutions I work with think about the fraud tech stack or the fraud stack. So it's not one tool, Ron. It's like this is a device recognition, and this one is a network of check fraud, and so they really think about a stack, and they keep looking for the next entrepreneur with the next tool, and that could be machine learning, AI, but they're just going to have a lot of lines of defense on fraud. I do think, I go back to a company like Verifin, who long ago said, have integrated case management for fraud, we still don't see that fully deployed. The idea that if something's going on with ACH and something's going on with login and someone's at the teller line, we're starting to aggregate that information. So keep working on that. And the final one is get creative on customer education. Especially, we see some great commercial banks educating small businesses on what they can do. Because even though an agreement may say it's on you, small business, it really stinks to tell a customer that they've been defrauded and the bank's not going to cover it. So everybody says they're educating. I would ask, are we being creative enough to make it stick out there as messages and learning in the marketplace?
Yeah, great points. Steve, let's move on to the next topic. I know you wanted to talk about some regulatory trends here as well.
Yeah, it's what, like you said, happy days are here again. The regulators are going to get off our backs. And we know there's this big, enemy of the bankers and credit unions, the CFPB. So the dreams are coming true a little bit about just how much shade is being thrown on the CFPB. But then there's this kind of, wait a minute, there's going to be potentially regulatory simplification, restructuring with Mr. Musk running around with his baseball cap on and his kid on his shoulders. So now there's a little bit of anxiety of, wait a minute. So a couple things. I have no clue. Usually when there's big saber rattling on regulatory consolidation, since I've been in this business since I was 21 years old, it usually tames down after a while. This is pretty serious, though, with the kind of things being looked at in Doge. So if I'm in Vegas this morning, my prediction is that they will take away the exam role of the CFPB. They probably will put it somewhere, potentially the OCC. That's what Jamie Dimon has recommended. I think what's important is Russ Voigt, who's the Office of Management and Budget, who was the interim head of the CFPB, who said pencils down a few weeks ago. They now have a permanent nominee for the agency. But, I think it's important to know he was one of the authors of Project 2025, who said merge the FDIC, the OCC, and the NCOA. If I was a credit union, I might be nervous that, integration into FDIC is not completely out of the question. If I'm in Vegas today, I bet all those agencies stay the same, but they promise streamlining their regulations and their exam process. And CFPB is no longer an examination force. It gets rolled in. There still is going to be consumer regulation. I think you've written, Ron, CFPB becomes more of a consumer watchdog and educator, but not necessarily an additional regulatory exam force. That's how I'd bet in Vegas this morning. That'll be completely obsolete by tomorrow afternoon.
Do you foresee, Steve, anything from the CFPB that they've put out in 2024 surviving? And I'm thinking specifically of things like the rate caps, the price caps on overdraft, and things like the open banking 1033.
I think the overdraft is going to be dead. I think what's interesting about this free market administration is while they're going to kill rate cap, then you see a bill proposed on a 10% interest rate cap on credit cards, which is incredibly populist and technocratic and not free market and not even smart. So, again, we can't predict exactly everything, but I think most of it's dead. I think we should talk about 1033 because somebody besides the CFPB is heavily in favor of 1033, and that's the fintechs and the aggregators, right?
Yes, but not necessarily the banks. We actually asked about that in the survey. We asked what will be the impact of the CFPB's Rule 1033. A third of the respondents, and this is aggregating both the bank and the credit unions, about a third, 32%, said won't be a benefit to either the consumers or the financial institutions. 21% said benefit to consumers, but not the financial institutions, which means a slight majority of the respondents thought it was not good for the industry providers. But keep in mind, too, that it does not mean that the other 47% said it was a benefit, because there were 27% who said they're just not sure what the impact was. Only 1 out of 5, Steve, thought that this would be a benefit to both consumers and financial institutions. And I got to tell you, I'm not sure I agree with everybody on this one, because on one hand, I actually don't think it's going to be that much of a benefit to consumers. I think they're going to get overwhelmed with like today, you can't go to a website without being asked if you want to see all the privacy and things and click and, accept the cookies and all of that. And now, for a lot of consumers who do business with a lot of fintechs and providers, they're going to have to be managing all of these requests, to share the information. And I also think on the flip side that a lot of bankers are not seeing the opportunity to how this could benefit them. So I'm kind of disagreeing with a lot of our respondents on this one, Steve.
Well, if I'm a big banker, of course I oppose this. If I have all the market share, why do I want to make it easier to move? So that's obvious. And if I were their lobbyist, I'd say the same thing. I think what's interesting was the kind of the rallying around the FDX, API standard or messaging standard, and where that goes anywhere. I just believe markets ultimately create the standards, not technocrats or bureaucrats. So the only wild card here is if Elon says, I have a new standard, it's called the X.com wallet. That will be where all money flows. But we'll see. But I would say this is a slow burn, nothing to really worry about in 25 or plan for. I would see what bakes.
Yeah. Just remember, Steve, that these respondents are overwhelmingly mid-sized institutions.
Right.
I'm trying to get Jamie Dimon every year to answer my survey, but I'm not getting there.
The busy guy. He's yelling at people to get back to work. He's quite busy.
But I can't. Sure, but certainly has time to fill out my survey. Come on. Okay, so now we can get to the equities. I was missing a few slides here in my little cheat sheet here. So, okay, I know you've got some thoughts you wanted to share about the stock price.
Well, I mean, if you see a little shine in a banker's face lately, it might be because of this. This is the stock performance of a regional banking ETF or index. Community banking looks similar, up about 30% in 1 year. So it was quite an actually place to be invested, especially from middle of 24 till now. So that looks like, oh my gosh, banks are kicking butt. But if we go to the next slide, Ron, I want to zoom back out because this is really a recovery. And if we look at the last 5 years, if we look at since the anniversary of COVID, March 2020, and look at where regional banks are. They're the dark that kind of bounced around but gone nowhere. So the recovery is really back from that horrible trough of April 23 after SVB, where banks, people are wondering what's going to happen to banks, or is there going to be a run? There are going to be a lot of bank failures. As an example, Western Alliance Bank here in Phoenix, where I live, their stock got down to 27. It's back up to 92 today. So huge panic was in the market. Now, I think the question is, why have banks through all this underperformed the S&P and even underperformed a large bank like Chase? So the S&P, you could say, was top heavy with a lot of tech. But why would Chase as a bank even outperform that? So any thoughts on that, Ron?
I've got two explanations, neither of which I would venture to guess are right, but I'll go and venture my guess here. Number one, I think a bank like Chase is far more diversified from a revenue perspective. They've got institutional, they got huge credit card. I mean, it's just, but the other thing, Steve, that strikes me is why this isn't a fair comparison, Chase versus regional banks. Chase has a very high profile CEO and a whole team that does investor relations. I mean, they are managing Wall Street's perception and expectations of them. There is nobody who represents regional banks. So when we aggregate them all, you're aggregating the higher performers and the lower performers into an average. And so I think that may help to explain some of it.
Yeah. I mean, but, all money is green and it has to flow based on, Bloomberg monitors every morning. I think the lesson here is, you said this to me before, Ron, if your business is we take in deposits and we make loans and we have no interesting niches, no sources of non-interest income, I'm going to trade at a lower multiple forever. So I got to be thinking about, how do I become what we call a smarter bank? What does transformation look like? Because as much as getting earnings and safety and soundness in my income statement and balance sheet and loan reserve, how do I get some intellectual property, some IP in my business that makes me unique and gives me a higher multiple? So big question I'd ask in strategic planning the next 5 years.
I couldn't agree more. Another topic, Steve, I think is going to be at the top of the list, or towards the top of the list for a lot of banks and credit unions in their strategic planning efforts. is not just technology more generally, but specifically around artificial intelligence. I think it's been huge topic.
Right.
And I wanted to point out one of the questions we asked this year. So before I get into this data set, year over year, definitely seeing growth, huge growth in things like chatbots and conversational AI. Robotic process automation has been around for a long time and now gaining a little bit more attention as these agents and the topic of agents come up. But one of the questions we've asked over the past couple of years is around the use of generative AI tools and agents in particular. And a couple of things I wanted to point out here is that, first of all, the comparison of the banks and the credit unions. Nearly 3/4 of the credit union respondents said that they see using generative AI agents in the contact center versus less than half of the banks. And keep in mind that unless there's a misunderstanding of the technology, this isn't simply chatbots, because that could be conversational AI, not necessarily generative AI. And then the other things I really wanted to point out here, Steve, that really kind of worries and concerns me. I actually pointed this out on LinkedIn yesterday, is you've got basically 1 out of 5 or less respondents on both sides of the coin who are planning to or already using generative AI for IT, compliance, credit services, finance and accounting, and legal. And that worries me because there are just absolutely huge opportunities to deploy these technologies there. I think maybe even more so than in fraud, where it might be more machine learning than generative AI. So this kind of worries me that there is still a lack of awareness and specificity about what these tools are, what they do, what the technologies are, and where the opportunity is. This is not simply, hey, we were afraid of bias, because that applies to lending. You don't care about bias in legal and finance and accounting, or regulatory issues. No one's come breathing down their throats to, on regulatory for credit services, finance, accounting, and legal. So these numbers really kind of concerned me, Steve.
I think they kind of map with political power in a bank, which I feel sorry for the back office, because the truth is, when you look at headcount and salary dollars, yes, we need to make the back office more efficient, but they've been bled dry for 20 years in many respects. I think it's, credit and finance are closest doors to the CEO. And so they're like, we're good. It's the other people where we really need to drive efficiency. I couldn't agree more. If you look at the whole commercial credit process, both from origination and then ongoing portfolio management, there's huge opportunities out there. So, picking at that, you saw someone like Numerated get acquired by Moody's because they were talking about, AI helping gather information and give you that first draft of the credit memo. So we take, from a typical commercial officer, I'm an artiste, no one can replicate my art. But now we're showing, actually 80% of it, we can get the ball done really quickly with systems. So I think digging into that's absolutely right. I think, Jack asked earlier, can you be more specific? Because everybody says customer service and fraud, but those are pretty big platitudes. One thing I'm seeing on contact center from our clients, Ron, is off hours service. I'm not going to have the contact center open 24/7, but I'd sure like to provide some answers. I am seeing that helps really, augment customer service with some pretty good answers to, some 80/20 kind of questions. I think on the fraud side, just all the pattern recognition on who is this IP address coming in? What are they doing? Have we had 7 like this at other places in the last week? I do think it's that. How are we recognizing, inbound messaging and communication a lot when it comes to cybersecurity and fraud? Those are some of them. I think the average bank has kind of said, we just licensed Copilot. We have a usage policy built. And we've got a knowledge base where you can do Q&A internally on the intranet. That's about where most people are. And I think the healthy thing to say is a year and a half after ChatGPT has been introduced, we still have work to do. We got to get our middle managers digging in even deeper.
Yeah, so I want to address one of the comments that Jim, I don't know Jim's last name without Alyssa. It's funny, looking at some of the comments, Steve, I only see first names, but I can kind of guess by the tone of some of their comments. Like I know who they are.
Just some of your buddies.
Yeah, Mike, I know who you are, Mike, about don't feel sorry for the back office. But Jim says, surprised this graph doesn't differentiate between using and planning. And that's because I didn't want to ask the question twice in the survey, and because I knew that the using currently would be pretty low.
Pretty low.
The other thing I wanted to point out here, Steve, is we're doing some research right now, commissioned piece of research, looking at the impact of AI more broadly, machine learning, generative AI, conversational AI, robotic process automation on operations.
Mhm.
And not a lot of great stories right now, as I think a lot of folks are still kind of in the early stages of a lot of this. But one of the things that has been very consistent in the interviewees that they've all said, look, if we could have done something differently, we would have gotten our data in order earlier. And one of the things that we asked about in the survey this year was about the effectiveness of the respondents' organizations' data strategy, data governance, use of data to enhance the customer or member experience, and the use of data to enhance operational efficiency. And again, this might be just the respondents' general conservatism of, not effusing too much, but the very effective numbers are pretty low, and the not effectives on the impacting the experience and efficiency
Mhm.
seem way high for me. So, I think there's a lot of work that's going to get done in a hurry to get a lot of this in order. In fact, last point, I'm going to plug something we're doing. We're actually working on another study, Steve, looking at what we want to call data IQ. So for anybody who's has registered for this, I will be hitting you up to take the survey on rating your institution's data IQ. Your
Yeah,
thoughts?
and well, I mean, I'm going to be a grumpy old man because I get to now because I've been in this industry. I think it was like 1995, Fiserv introduced the first data warehouse product called Informant. Was out of their Mellon Pittsburgh group. It was cool, but we're now celebrating the 30th anniversary of bank outsourcers introducing data warehouse products. So it can't be the technology. We've got now Snowflake and Power BI and Azure and other things. I think the words that are coming up a lot in AI discussions is indexing and categorization of data and building a history. So I would go back to my organization and kind of say, let's take a hard look at our indexing, categorization, and creating history that's going to be needed not only to use AI, but if I cross 10 billion, how am I going to pass my model risk management exams? How am I going to, show I've got control? And here's another thing: how about I manage the enterprise more effectively, like someone like Amazon, who has 250 data points every day they manage the machine with? So I think we should be pretty embarrassed by this one. Data is not a new topic, and it's really the hard work we got to do about getting it organized and categorized, et cetera.
Agreed. And I think there's whenever I'm in a board session, Steve, and somebody brings up data, I always try to interrupt and go, like, what data are you talking about? Transaction
Right.
data, customer data, operational data. But I think what often gets overlooked, Steve, in this discussion is the qualitative data. I remember reading Chris Nichols, who's just absolutely prolific about writing this stuff and one of my favorite folks to read. And he had written that they were toying with the idea of asking the bank, South State, to shut down email for a couple of months so that they can get things in order. I mean, obviously, that's not a realistic thing. But the whole thing you're talking about from categorization indexing is
Mhm.
as much about the qualitative data, the things that are in policies, the things that are sitting around in emails and reports. It's not the
Mhm.
stuff in databases itself. And I think this is what's hampering a lot of the generative AI efforts.
Yeah, and what I'd say, because I'm seeing some great chat about, I live this every day, and ask so what and who cares on the data. Don't just produce mountains of data. Don't roll out a techie to show you the possibilities of Snowflake or Databricks right now. Bring in Grumpy Joe from the back office saying someone needs to decide how we define commercial relationship. Do we include this or not? Like, get into the real brass tacks discussions about definition, data dictionary, because those aren't fun. They're like flossing, but you got to get them done. And I that's the activity I don't see. I just don't want to see another showcase of a techie saying it'll be easy. I'd rather have a grumpy person saying we got to decide on some of this stuff.
Right on. Okay, I want to go on another topic, Steve, and I'm going to pull an audible here and skip one topic just in the time so we can delve into some of these other things.
Mhm.
Also wanted to talk about fintech partnerships, which has been a top concern for a lot of institutions over the past couple of years, and kind of noticed some well, interesting, if not disturbing trends. From the
Mhm.
bank perspective, the percentage of respondents who think or see fintech partnerships as a strong driver of growth has trended down, ticked down over the past couple of years from about 3 out of 10 now to just 16%, holding a little steadier on the credit union side with a little bit of an uptick.
Mhm.
But the percentage who said not a driver of growth on the bank side jumped from 30% to 40%
Mhm.
over the year.
Yeah.
My take on this is I think on the bank side, it's a little too heavily influenced by the banking as a service
Yep.
nightmare of last year with Evolve and Synapse and so forth. And I'll tell you, this worries me a little bit. I was in a bank board meeting last fall, Steve, where I was advocating to the board and the management team that they should be a lot more aggressive about fintech partnerships. When one of the board members piped up and said, "Well, we've evaluated this already. We're not doing it. Move on." Clearly pushed a hot button. I said, "Well, why not?" He said, "Well, we're worried about the regulatory." There's no regulatory issues. We're just partnering with a fintech. And there was a mindset and a different, definition issue that was at play here.
Mhm.
And I think this is why the credit unions are still kind of ticking up. They're not as deep into the banking as a service slash partner banking as the banks are, but do see the need to partner with fintechs and third party providers to enhance their product offerings. That's what I'm advocating on both the bank and the credit union side.
Right.
Am I going wrong here? Or
I think
you,
you nailed it. I think it's if you look at the banking side, we had a lot of people looking at BAS as another source of deposits, and actually, retail deposits that most commercial banks aren't good at. So this could be a new channel for them. That, and we had banks getting into crypto, right before FTX became famous. So those two things really had bank regulators saying we don't like BAS and we certainly don't like crypto. And I think that became a lot of the brand for fintech partnerships. And then some of the early fintech, I think, proven use cases were more consumer banking than commercial banking or treasury management. So that may be as well. The one lesson I'd give to the credit unions, though, if you look at something like the Circle Fund, which has grown into the hundreds of millions of dollars, but more importantly, a lot of active engagement with those fintech entrepreneurs, it's not just a passive investment from a venture capital standpoint. It's like, hey, we've deployed some of our capital. It's engaging those fintech entrepreneurs, learning from them, and then pushing back on them. Like, you have a dumb mousetrap idea, but you guys seem pretty smart. What if we did this? And I see some of that going on with the credit unions that I'd like to see even more coming out of. We've got some great organizations, Bank Tech Ventures, Jam FinTop, Menden Partners, Alloy. So I'd like to continue to see that activity. And I think for banks, don't consider it BAS. Consider it bringing fintech into your delivery system, into your tech stack. And one thing I'd also say is the collision of banking and fintech is how we're going to get the younger generation and more diversity, racial, ethnic, gender into banking. So I think the collision of banking and fintech is going to be healthy for banking.
yeah, I totally agree with you, Steve. At much to the uh, the the consternation of everybody who would like me to just argue with you about everything. But I do think you're making a couple of very good distinctions here. First of all, the distinction between embedded finance and embedded fintech.
Mm,
And I do think that's an important distinction. The other thing is the distinction between embedded finance and banking as a service. Because I think a lot of their opportunity, especially for banks and credit unions, is to embed their products, not just partner with the or provide the license to fintechs, but to actually put their products into third-party providers. I often say that the big opportunity, especially on the small business side, is with the vertical SaaS providers. I've also
mhm.
learned just this week, Steve, that according to Wade Arnold, at Move that vertical SaaS applications is actually a VC generated term. So I'm going to stop using that and find something else just so that they don't get to create all the language we use. But for the time being, that's where there's a lot of opportunity to reach vertical markets and from both a lending and deposit perspective. So I think there's a lot of play there. The other thing I'll tell you is that despite the fact that we see this decline in the percentage of banks who say that they see fintech partnerships as a strong driver of growth, the percentage who say that they're planning to get into banking as a service specifically has not declined. It's a small number for sure, but there still is a 5, 6, 7% that's been consistent over the past couple of years who say they are getting into BaaS. And I was looking at the fintech meetup list of banks that are going to be there, and there's a whole bunch of banks there who are saying, we're getting into BaaS. So it's not dead.
Yeah, maybe we've gone through the trough of disillusionment with BaaS, and now it's time for the slower build of the real players.
Great. Okay. Next time, by the way, I think and I don't think it was Laura who asked about the getting fintechs integrated in and stuff. I think one of the challenges that a lot of banks have, Steve, is they'd love to do this, want to do this, but are struggling from an integration perspective. In fact, it just consistently is one of the issues. Sorry for the eye chart here. We've asked past couple of years about bank and credit union satisfaction with core providers. And I can't even begin to see. Okay, so over on the right is the ability to integrate with third parties, which is actually increasing if you add together both the very satisfied and somewhat satisfied numbers. But there were a couple of things I wanted to just kind of point out here, Steve, at a very high level. I was actually kind of surprised to see that over the past couple of years, and I don't even think, we do have the legend there, that going from 2023 to 2025, that the overall satisfaction levels for some of these attributes is actually on the rise with banks. And it's funny, I just saw today the ABA put out a survey on satisfaction with core providers. They asked different questions, but actually are seeing the similar uptick on the trends. On the other hand, on the credit union side, especially for a bunch of the attributes over to the left-hand side of this graphic, we're beginning to see a steady decline in the overall satisfaction levels, which have been higher for the credit unions than for the banks for sure over the past couple of years. The integrations on the far right, fairly stable, but things like helping them compete and grow in existing markets and response and so forth continuing to decline. What's your take on these two trends and perspectives?
Yeah, I think the healthiest thing we can do as leaders of banks and credit unions is just see the core market for what it is in many respects. Used to be the old days of these companies were full service. Whatever you need, whatever wraps around the core, we'll integrate it. With the payments revenue being the dominant thing for those players, they're less interested in giving you the full stack. So what we're seeing today is more maybe lowered expectations for the core to be my quote partner. And there's a new ecosystem out there. I've got digital providers, I've got fintechs, and now we see I've got middleware providers, a Core 10 or a Sandbox. I've got integration companies out there like a Trabian or something. So I think there's a new ecosystem out there. And to survive in that ecosystem, you have to be realistic about what the core is going to give me and not give me. And additionally, I think you have to build a talented workforce of data people, integration folks, UX, architecture folks who can help you kind of bring that together for your strategy. And that's not easy if I'm 500 million. It's absolutely critical if I'm 10 billion. So it's going to help. It's going to drive more consolidation because there's a cost to do this. But I don't see how you integrate fintech and other things without having more partners and a different type of IT group for the future.
Totally agree. And I got to tell you, one of the things I learned looking at the ABA report is that in future versions of what's going on in banking report, I am going to be asking, how long have you been on your current core's platform? Because they looked at that, ABA did, and I think one of the interesting things they came out with is, and probably not surprising to anybody, but the longer the tenure, the lower the satisfaction. And I'm not capturing any of that here. So I need to, in the future versions of this, kind of capture tenure
And
on the
not to say
platform.
there won't be innovation in the core market. You've seen great uptick by, correlation, which was, introduced, a decade plus ago, but is seeing gain market share in the credit union side. We follow, our team follows all the new cores coming in, some from overseas, like a Tata in the banking side or a Temenos. But we would just say Thought Machine, you still run into a very complex industry called banking. So a lot of the techies who are very wide-eyed about this is going to be easy building a core system, face a dose of reality. So those things move slow. And I think it's important, look for areas of core innovation and look about maybe how I unbundle the core more in the future, especially if I'm a larger organization. But the real action is going to be integrating fintech with my digital experience and data with my digital. And it's a lot of things around the core where integration's there. And Liam pointed out, willingness to integrate doesn't equate to execution. Absolutely true. Who's got the dirty fingernails to make it work?
Well, we did capture willingness and ability, so I just want to defend my methodology here. So, Steve, I'm looking at the clock, and I'd probably go on for another hour and dig in all these things, but I want to, and I know that Marcia just brought up instant payments, and sorry, Marcia, we actually skipped over that one slide because of time that I wanted to get to. But I want to close, Steve, and get your thoughts on something that for me is just this nagging trend that, and I have to be honest, I've not done the hard work of getting my thoughts together on this, but my thoughts is that we are moving from a focus on high volume process digitization and automation to an environment where a lot of these AI tools are really about augmenting the knowledge workers in the organization. And the new focus, I think, is going to be on creativity, problem solving, not artwork and coming up with the next $1 trillion product. None of us are going to do that. Maybe one person will do it, but it's really about creativity. And we've been discussing this, and you threw in a slide here that I think is just awesome at sort of capturing the need for automation and automation rules, creativity rules. I'm sorry.
Well, I mean, first of all, we're going to have to wake up every morning and now have the scrutiny individually of, is this real? So, but I think it also gets to your point about creativity and the mistakes we may make or the things we don't do creatively versus the mistakes we didn't make by staying inside the lines, if that makes sense. So if I were a CEO right now, I would be looking at my team and saying, get creative on growth. We have to grow, and growth in a plain vanilla world isn't easy. So guys, where's the niches that we're building? Are we integrating with those SaaS providers in treasury? What are we doing with next generation marketing? What does our social footprint look like? What does it mean to be a salesperson in a multi-channel world versus nobody's coming into the branch? So I think you have to get very creative on growth. And I think to your point, Ron, I got to challenge, especially my middle management team. Are you jumping down the learning curve with your vendors, with your processes on AI use cases, data use cases? You have a great dashboard to drive your business. So yeah, I do think challenging the team to be more creative about reinventing what does what we call a smarter bank look like is what could be the big mistakes. It's not that I did something wrong. It's I didn't proactively get creative and do something right for the future.
Yeah, awesome. So, Steve, I'm going to kind of wrap us up here. I want to thank everybody who joined us for listening in. We have been trying to monitor the chat. It is just, they keep coming at it and finding it hard to just keep looking over to the right and find it. But thanks, everybody, for throwing your thoughts and comments and questions in there. If you don't already have the report, get your phone out, scan that QR code. I made sure that this link goes straight to the report so that you don't have to re-register for it because we already have your names and contact information. So thanks a lot for joining us. And if you need to get in touch with either Steve or myself, here's our email addresses. But I'll tell you, LinkedIn is a much better place to capture it. But Steve, it's always a pleasure for me to actually do work with you. I'm coming up on 10 years at Cornerstone. I think I can count on one hand the number of times we've actually worked. So I enjoy these opportunities.
Thanks. And I love the chat too. It's just like our internal meetings where the chat's more interesting than the speakers. So
Wow.
to everybody out there, I think these are some of the folks really, in the trenches trying to do some of the stuff we talk about. Hey, let's build a smarter bank. So thanks to everybody for coming. I know the chat is informative for other participants.